on European markets based on, I think, SAFE's updated comments. What do you make of the story and the likelihood of it happening here? Because let's be frank, it's not a new rumour.
Yeah.
But this time round, the market seemed incredibly sensitive to it.
First, I don't think it's relevant. Second, I don't think it's going to happen. Think about this. China curbing its purchases of treasuries means a big threat to its trade surplus. So it's not an easy balance. You know, there's a quid pro quo here in buying treasuries for them. Second, China is not even the first foreign buyer of U.S. treasuries. It's Japan. So there's plenty of buyers. The first buyers of U.S. treasuries are the U.S. funds and Social Security and pensioners. Therefore, first, I don't see the risk. Second, I think that the reaction is a little bit overheated, probably more to the fact that the rates are going to continue to increase and that inflation is picking up, rather than this rumor that happens and that comes up from time to time. So I'm not worried about that. I continue to think that there is a healthy demand for treasuries. Actually, much more so as the Bank of Japan and the ECB continue with their monetary stimulus.
The suggestion that Steve was making was that perhaps this is just a little tug on the leash by the Chinese authorities, get a journalist to put the story out there, make Trump's administration a little bit nervous, and then ultimately deny that you sourced the story.
Yeah.
What do you think?
I would agree with that. I think that all these rumors that are happening that you're seeing in the markets about yuan-traded oil ETFs, etc., are a little bit in that direction, in the direction that China plus Russia might put an end to the US dollar supremacy. I think it's, to be fairly honest, extremely unlikely.
Well, we'll leave it there because you agreed with me, so that's fantastic. Dan Lacalle, we'll see you for the rest of the show, of course. The countdown.
Tesco's 1.9% rise in like-for-like Christmas sales fell short of expectations as lower demand for general merchandise offset strong growth in fresh food. However, the British grocer said it was confident for the year ahead, adding it was on course to deliver on its medium-term goals. Richard Lim is with us, CEO of Retail Economics. Richard, let's just test out some of the theory around the numbers. We saw fresh food very strong for the likes of Tesco. General merchandise was mixed. You saw clothing still just leaning slightly positive, but the rest of the space very, very challenging. Does any of this matter when you've got a business focused on its core market and on fresh food and groceries? Does the general merchandise even matter for a Tesco's?
Well, I think the first thing to consider is that a lot of this growth is being driven by food inflation. So food inflation is running about 4.1%, which is actually at a 4-year high. So these overall figures for the food part of the business is actually being flattered by food growth.
But Tesco says it didn't pass on as much to its customers because it worked with suppliers. You still think that this is that typical story which we looked for initially when there was a talk of inflation? It's usually positive for the retailers. Do you think it's just back to that same old story?
I think it's inevitable that a lot of these cost pressures have to be passed on to suppliers. If you look at a lot of the supply chain costs through the PPI data, then a lot of this is being passed on to consumers. Of course, if you look at the main drivers of inflation coming through food, transport and housing, that actually those three parts of the consumer basket account for about 50% of expenditure for the least affluent households. So this is having a knock-on impact on non-discretionary spending elsewhere, and this is the effect of what we're seeing in general merchandise as well.
So if you look at, forget about the results that they've published, guidance. Considering that most analysts and everybody in the street is looking at inflation creeping up a little bit further into the year, precisely coming from food, energy and housing, what about the guidance? Do you believe in the guidance that they're giving? Everybody's saying that they're keeping their guidance. Is it at risk?
We think that things are actually going to get a little bit tougher before things start to ease. So our forecasts are for inflation to have peaked around about now. We expect it to fall by about 2.5% by around about the spring and by about 2.2% by the end of the year. So in terms of real incomes are in negative territory. They've been in negative territory for around about 6 months. We don't think we'll see real growth in earnings until about the middle of 2017, and that's when we think things will start to pick up. But there's other pressures as well, pressures on credit, pressures on Brexit, the effect that this is having on consumer confidence. All of these are key components that will affect consumer demand.
So we should put a little bit of at least a little bit of caution on these guidance for the year at least.
That's our perception, is that the consumer environment will get tougher before it gets better towards the end of the year.
Two things. Tesco's CEO says he's really happy with the pricing position of Tesco's over Christmas. So that's what Dave Lewis is saying. But the shares are seen down 2% after missing expectations. 1.9% increase in like-for-like. Again, it was respectable, but apparently the analysts were looking for a much bigger figure, up as high as 3.2%. I was tough on Marks & Spencer's. I said they were pretty rubbish figures as well, and that actually they should be doing better after all these years on a negative 2.8% on clothing and home. Have I been too tough?
It's a tough consumer environment out there, and I think one of the things that we haven't mentioned as well, of course, is this relentless shift towards online. So we've actually did our own research, and we found that about 2/3 of consumers did some of their shopping online. So while especially companies like Marks & Spencer's, those incumbent traditional retailers, they're burdened with lots of stores, with long leases, upward-only rent reviews. Yet they're seeing this seismic shift in the way that consumers are spending their money, and so there's the soft consumer environment, but their business models are under intense pressure as well.
That's a really interesting point. Did I read that one of the biggest retailers, and I think it happens all around, and I'm sure you'll give me the name of it, I thought it was Debenhams, but did I read that somebody, or House of Fraser, was looking for an updated rent review from their landlords as well? First of all, that's accurate?
That's House of Fraser.
That was House of Fraser as well. Given the pressure on the high street, and actually the big stores which these kind of companies have as well on the high streets, is the rent environment going to get better for them anytime soon? Because the alternative is they go bust in many ways.
Of course. The rent environment is very difficult to pick out for the industry as a whole. Lots of individual retailers have deals with their landlords, but the market overall, though, the important points here is that operating costs are rising. They're rising by about 3% year on year, and that's outstripping sales growth through a lot of retailers. And if you take rental costs, labour costs, that's over 50% of their operating costs, and they're looking at things like an increase in national minimum wage, national living wage. So there's these spiralling wage costs, these spiralling operating costs. And then on the other side, that's just one half of the story. On the other side, you've got rising sourcing costs from all of the effects of Brexit and some of those import prices still coming up.
Toxic mix.
Which is where you come back to the digital offering, really, and the challenge to all of these bricks and mortar retailers, from Amazon and other Amazon lights. I mean, to what extent does that relationship of higher costs and lower profits never change for many of these companies? Because as they continue to try and trade their way out of this situation, Amazon is nibbling away at their margins.
Sure. And these are the conversations that will dominate boardrooms, throughout 2018 and beyond. It's about embracing, innovating, and adapting to these changes. So if you look at Amazon as an example, again, our research showed that about 37% of consumers did some of their Christmas shopping online. I mean, that's a terrific proportion of the market that's going to a pure online retailer, and that's bound to be hurting some of these retailers. But the retailers I speak to, though, they talk about WACD, what Amazon can't do. There's no, in a way, there's no point trying to compete directly with Amazon. It's trying to create an environment that Amazon can't replicate. So this is about creating in-store experiences that are really meaningful, educating their customers, giving them an environment, entertaining them, and often providing some form of escapism to live their everyday lives. So they need some point of differentiation.
So Richard, what is that? I mean, we've been debating Argos, more Argos in store at Sainsbury's. That means more product categories, more general merchandise. Is that what you would call an in-store experience, or is there something quite different to that?
Well, Waitrose is a good example of a grocery retailer that's providing a meaningful in-store experience with the way that they their product ranges, the way that they display their goods, and even things like sushi bars that they've incorporated into their store environments. Free coffee, exactly, another example. But it's just trying to find that point of differentiation and building that brand equity.
Do you think some of these retailers are carrying too many lines of product? I mean, for instance, Tesco's CEO is just citing some of the weakness in home computing and entertainment. I mean, who buys a computer from Tesco? It's not the immediate place where you think of, I'm going to buy a computer, I'll go to Tesco. I mean, Marks & Spencer, I want to buy some furniture, I've got to go to Marks & Spencer. Do you think that the strategy is still very old for these retailers, behemoths of industry, wanting to have a finger in every pie, every category, but that strategy's still got to change because it's not just Amazon, it's other online competitors, it's other high street retailers that are dominating that space, and this is now proving a drag on the earnings of some of these companies?
I mean, it's a fascinating point because if you look at the grocers, Tesco's the prime example here, they've really restructured the business over the last few years since Dave Lewis has come in. They've really focused on the food business, they've reduced the number of product lines that they have, and essentially they're moving more towards the model of the discounters like Aldi and Lidl, where they can work and focus on fewer lines and really trying to push through some of those savings on supply chains, on the contracts they can have with their manufacturers, and remain really price competitive.
We're done. Richard, nice to see you. Thank you very much indeed for that. Richard Lim, CEO of Retail Economics. I'll say M&S haven't got an opening call on this one yet. Tesco's called down a couple of percent at the start of trading. The NBA tips off in London, and its most successful team in history is in town. We're going to speak to the co-owner of the Boston Celtics ahead of tonight's game against Philadelphia. The NBA returns to London tonight with the Philadelphia 76ers taking on the Boston Celtics. Celtics are on a 6-game winning streak and flying high at the top of the Eastern Conference. Steve Paliuka is the co-chair of Bain Capital, but also co-owner of the Boston Celtics NBA team. Steve, nice to see you.
It's great to be here.
So, look, how well does the franchise travel? I mean, we've seen the NFL for years building up its presence in the UK and overseas as well. How well does the NBA franchise travel?
Travels very well. We're sold out for the game here. We've played in Barcelona, we've played in Istanbul, we've played in Milan, and the fan interest is just incredible. It's great to be here.
Yeah. What about the revenue side of it as well? I mean, bums on seats in an arena, fantastic, but I don't even know what the O2 is, about 28,000 maybe? I'm not, or maybe even a little bit less than that, actually. But
about 20,000.
About 20,000. So, I mean, that's great, but in terms of what you're really trying to do is probably drive revenues on subscriptions and trying to get people to watch it on a regular basis as well, and obviously build the advertising around that. How's that business model working?
It's going very well. David Stern and Adam Silver really pioneered global sports, and they were in China very early, I think back into the 90s, setting up offices and getting out ahead of the whole trend that's happened now. So it was revenue when we came in the league. We bought the club in 2003, was in the kind of the tens of millions, and now it's in the hundreds of millions and growing very rapidly. So huge demand all over the world for basketball.
Fabulous.
Can I take you in a slightly different direction?
Yes.
The rest of the world right now is trying to figure out Donald Trump. We've seen this tax program passed. We're trying to work out what that's going to mean for business. And now Donald Trump is apparently heading to Davos to meet Davos Man, which we're all trying to figure out why he's doing that. Steve, you once, I think, looked like you were going to run on the Democratic ticket.
I actually did run for Senate at one point.
Right, great. So that puts you square. That makes the audience aware of what your political allegiances are. Is your sense that President Trump is good for America or bad for America in business terms?
Well, I really don't think the issue in America is President Trump. The issue globally has been basically a lot of people have been left out by the internet revolution. And that's what's happened in the United States. You know, we have a whole middle of the country who hasn't progressed like the outer edges, California, you know, New York, all the places on the East Coast and West Coast have done very well, but we've left out a bunch of people, and you're seeing that globally. You've seen that here with Brexit. So there's people saying, hey, we want to get part of that pie. We need to have mobility, and that's been the issue, and that's been the issue globally.
You think Fire and Fury is an accurate representation of what's going on in the White House at the moment?
Look, we don't pay a lot of attention to books or any of those kinds of things. At Bain Capital, we're really trying to grow and build great businesses. And so we work within the constraints that we have. And again, if you look at the U.S. economy, irrespective of the political situation, low unemployment, expanding, job growth, and things are going in the right direction. I think what we really have to do is have corporations, business, government get together and increase our educational opportunities so we can find jobs for everybody in the country.
But what the White House does is having an impact on the markets at the moment, it seems to me. The tax deal suggests a fiscal expansion that already the bond market is beginning to react to here. And you obviously take a close look at what's going on with the 10-year Treasury as everybody prices off the risk-free rate. What do you think Treasury yields at 3% by the end of this year would mean for what you do?
Well, look, the good news for what we do is we can adapt to any conditions. We're trying to really grow companies. Right now, markets are at an all-time high. They're really at all-time highs. Interest rates have been as low as they've ever been. So I think most people are expecting some gradual increase in interest rates irrespective of who is in charge, because we've had such a period of low rates over time. On the other hand, the big issue, I think, for us is deficits. Deficits are growing. The 20 trillion in the United States is the national debt. When I got out of school, it was 1 trillion. So that's been a massive increase over our careers. And so I think that's the next issue that they got to handle. And they got to bring interest rates up, but not so much that it's going to affect what's going to happen with debt payments.
Look, I've given you an opportunity a couple of times here to have a swing at Donald Trump, and you've ducked them both, which suggests to me that you really don't want to go to that space. Do you actually think then that the administration may be bedding in here, and that the snafus of the first year may be in our past, and Trump may be doing something right for the economy?
Look, the American government has lots and lots of checks and balances, so the president can only move it so far. So I think, again, the issue we have is we have to have the whole government come together and put in policies. There's some good things in this tax policy, bringing back trapped cash and things like that. So if they get together and do that, that's going to be positive for the economy. But as you look at it, the American economy is doing very well. We have record discoveries of oil and gas. We have a lot of alternate energy there. And so low unemployment, so things are going pretty well, and hopefully it'll continue to do that.
So for venture capital and growing businesses, multiple expansion has been phenomenal in the last 5 years. Low interest rates, people are taking a lot of leverage in many cases to justify businesses that are, let's say, in many cases questionable. How do you discern opportunities in an environment in which there's such a tremendous search for yield and for any type of real asset growth?
Well, that's a great question, and we've lived through the 2008 big crisis, and the short answer is you have to be very disciplined. So at Bain Capital, we have kind of archetypes that we look at. So we're buying 2 companies at once and putting them together, and we can grow market share and get synergies from that. We're doing very interesting transactions, looking at financial services. So it is a very pricey environment, but you've got to be disciplined, selective, and kind of stick to your knitting when you can really look at a company and say, we can transform it, we can grow it, we can gain share. That's the investments that we make.
You've got a finger in virtually every pie if you look at the number of different companies in the portfolio. Have you found an Amazon killer yet?
Amazon has certainly changed the entire retail landscape globally, and Alibaba is doing that in China as well. Now, we have participated in that. We have investment in many internet companies, and they're growing rapidly. But retail is going to be an area with a lot of dislocation in it. And I think the sales of mobile phones, e-commerce, have been up 7 times in the last 5 years, and we're going to approach in the next 5 years $1 trillion in spending. That's incredible.
Is there a way for some of the traditional retailers to get back in the game based on some of the new technology, the sort of small companies that you're investing in which have technology that's useful for the retailers? Do you think there is a way back into the game using some of this new technology?
Well, there's going to be a battle, and you see the e-commerce companies like Amazon, buying bricks and mortar to sell things. They bought Whole Foods. And now you're seeing companies like Walmart, develop a big internet presence. So that battle is going to play out. So far, the new upstarts have had an advantage, but now the retail companies are coming back, and they're selling products for the internet. As you see, the sales really shift towards an electronic mode.
You're on the preferred list of bidders, it seems, for AkzoNobel now on this chemicals business. If I read the runes right on this, what interest do you have in a turnaround of that story? I mean, what's interesting about chemicals for you?
Not to duck your question, but we don't really talk about deals we're in or not in. We're looking at many things. We have a great group here in the UK that really knows chemicals inside and out. So we look at all sorts of transactions. And again, what we're really trying to do is find companies that have a capability of growing and transforming and being different 5 years from when we buy them. We invest into them and grow them. That's been our record. We started out over 30 years ago as a consulting firm. We kind of spun out of a consulting firm, and we've used those skills to kind of grow those companies.
Well, let me ask you a broader question, Steve. I mean, you talked a bit about multiples and how expensive you see some markets as being at the moment. Is Europe a much better place for private equity to go fishing at the moment because we seem to be in the early stages of a recovery and valuations perhaps look better and CEOs are finally understanding that they need to dispose of non-core assets?
That's happening in a big way, and we've seen great success. We have a European team that's been here for 20 years that's had outstanding success through thick and thin, and we're seeing that dynamic right now. Lots of properties for sale. There's been pressure on banks to divest bad loans, and that causes companies to also sell and trade. So we think Europe's a good place to be. But if you step back, in Asia, we have operations in Asia, we have operations in Europe and the United States. And in Asia, you're seeing some fundamental growth there. So there's different kind of investing in financial services and things that are really driving China towards a service economy. Japan is also liberalizing. We've been very successful in Japan. Europe, you're right, there are opportunities there as well. And then the United States continues to be a good basis of strength for us.
But as I read it from previous conversations you've had, lower exit multiples globally. So tougher going.
It's definitely tougher going. When these markets are at these levels, we're often pricing our exits at the same or below the multiple we paid in, which means we've got to improve the businesses enough to withstand flat or lower multiples, and that's what we're projecting and trying to be conservative and disciplined in doing that.
There's been a ton of consolidation lately, you know, the cross-border deals, mega deals that have been clocked up by big listed companies to the expense almost where private equity seems to be cut out of the game to an extent. Big companies using script and huge cash stockpiles. Do you think the game's changing as we start to see interest rates tick up a little bit and it's a new cycle for 2018?
I really don't think the game is changing. Private equity has gained share constantly for the last 30 years in buying companies, and these things go in cycles and ebbs and flows. So the deal sizes are actually increasing. The largest private equity firms now have more global capabilities. There are 7 or 8 firms that can do deals in the size of 10 to 30 billion even today. So no, we see lots of opportunity out there, and again, we have to pick our spots and be disciplined. Obviously, if there's a large multinational corporation that has synergy, we're not going to beat them at an auction, so we stay out of those auctions.
Steve Pagliuca, thank you very much for joining us, co-chair of Bain Capital and co-owner of the Boston Celtics NBA team. We are going to take you to the market open shortly as we count you down to the open. 2 minutes to go, futures looking positive.
Horrible feeling, and I don't mean this in a bad way, that Marks & Spencer was going to rally today, because I saw some comment that said the food was better than expected, but I don't see how you can invest in a company necessarily, which, unless of course there's a valuation argument, and we'll come on to that now, like M&S, which habitually disappoints. Clothing and home, down 2.8% like for like. Food, which has always been great for M&S, down 0.4%. So I don't know what M&S's USP is at the moment. The multi-year chart on this one, and I say multi-year, I mean decades, is woeful. Doesn't matter what management team you've been talking about, Steve Rose, Stuart Rose, or before that as well. It just hasn't performed for you as well. The only thing I would say to you about Marks & Spencer is there's very little expectation built into this stock. It trades at 11.6 times, and you'll struggle to find a mainstream retailer, which is apparently on a recovery track, which trades at a lower multiple as well. So I would say there's very little faith, I'm afraid to say, on a stock that trades at 11.6 times in the recovery story. That flies in the face of Tesco, which has also got a recovery story under Dave Lewis. And this one trades at just under 17 times forward, about 16.4 at the moment as well, has traded higher as well. And actually, even though the annual performance of Tesco's is pretty average, I mean, it's pretty flat before today's move, the 6-month performance had them up 24%. Now, I thought the like-for-likes were very respectable, up 2.3%. Analysts, though, had wanted 2.4 to 3.2. But you've got 2 companies here which are falling for the same reason, which is underperformance today. One of them, though, is growing their performance in what Hayes CFO just told us earlier on the show is a really tough environment. The other one is losing ground in that very tough environment. 2 recovery stories. You can make your own mind up. One trades at 17 times, one trades at 11 times.
Kevin Bosher is with us. Kevin is Chief Investment Officer at Brooks Macdonald. Kevin, you've listened to the evidence. How do you plead? Marks & Spencer's or Tesco?
No, I won't talk about specific stocks necessarily, but as a sector, it's clearly a very competitive space. And I think what this shows is that for traditional bricks and mortar companies to survive against the online competitors, you really need an edge. Whether that edge is superior management, whether it's more efficient use of capital, whether it's an excellent online capability yourself, you need an edge. And those companies that have that edge seem to do pretty well. Those that don't are really struggling. From our point of view, our preference in this space is still in the luxury sectors, because at least in the luxury sectors, they're less price sensitive. They're selling to a growing and emerging middle-class consumer in emerging markets. And also at the same time, we live in an environment where the wealthy are getting wealthier. So our preference in the space remains in the luxury sector, but nonetheless, there are still some standout quality companies in the normal retail space as well.
Let's drag Richmond into the conversation, because that's been one of the reporters today, the maker of Cartier and jewellery.
This is the difference. This is what I have to put up with, Kevin. You've got Jeff and I, buying your discount retailers of this world. Karen, putting Richmond into the same conversation.
Well, we
that's the difference.
Food too,
that's the style of that lady over there compared with me.
What's interesting to me about this story, though, we look for the recovery trade often with stocks. When it comes to the UK high street, I think investors have already raked over that recovery story. Some of these big names getting back into the mix now. All different strategies are coming up. A Booker acquisition, which takes Tesco's in a different direction. Argos and stores for Sainsbury's and M&S just trying to do its thing. When it comes to the luxury companies, are they getting a revival in core markets that have been very depressed, the likes of Macau and Hong Kong? The Richmond numbers crossed today, and they cited double-digit numbers, I believe it was, in Asia-Pacific, but particularly coming through from Macau and Hong Kong. Luxury might just have another layer because you have a very downbeat market now that might be improving.
Absolutely. I mean, we shouldn't forget here that China it contributes half the global economic activity, and China proved to be much stronger than expected last year and will probably be similar this year. And emerging markets generally have seen their growth prospects improve over the last 12-18 months, largely thanks to the fiscal and monetary stimulus we saw in China from mid-2015 onwards. So those economies are doing very well. The middle class are growing and getting wealthier, and they like luxury goods. So absolutely, I think this is something that can continue.
So you think that we could continue to see a multiple expansion there, because it's not just been growth, which has been phenomenal and very, very good margins, but also a very strong multiple expansion. Multiples have increased by about 50 to 60% in the last 5 years relative to the earnings growth. So what is the next surprise? I think that all these things that we're talking about, I think everybody has more or less an agreement with.
Yeah.
But what do you think can be the surprise for luxury goods, specifically as inflation starts to pick up in the rest of the world and as emerging markets also start to suffer from that, no?
Well, I think in the US earnings are the key, because multiples there are much higher than elsewhere. But if you look at emerging markets, if you look at Europe or Japan, multiples are lower. And they vary from sector to sector. And Europe, Japan, emerging markets are much earlier in the cycle than we are in the US. So for me, in those areas, it's not just a multiple expansion story that limits them. There is plenty of scope for this cycle to carry on for some time to come. But equally, earnings are still a very important part of that.
What about margins? I'd be curious on the view from both of you, because a number of commentators this week questioning what's happening on that side. You've got operating margins at records in the States saying there's not really that much more room to improve. You've got inflation starting to come through with some wage pressure. Surely that has to be passed on to the customer. If it can't be passed on, then you've got to have lower margins. And I mean, here in Europe, we've seen all different stories this week. Sainsbury's saying we had a 4% increase pay rise for our staff, but we took it out with more cost cutting. I mean, we know a lot of businesses don't have much left to shed in this cycle. The other story with some of these businesses is, do they spend up on capex to try and improve the margins? So how do you see all this coming into the mix as you chase profitability through those operating margins in 2018?
Well, again, I mean, margins are still pretty high at near record highs in the US, whereas elsewhere not necessarily the case, and it varies from sector to sector. So we still see plenty of room for margin expansion in markets outside of the US, and indeed within some sectors in the US. And no doubt the recent tax cuts will enable some sectors and some companies to give a further boost their margins. But even if margins have peaked in some areas, what we're now getting is volume growth and maybe price growth as well, which is still very beneficial for some of those companies who are suffering from maybe tough margins.
No, I kind of agree. I think that what you cannot expect is margin expansion, but most of consensus is expecting a decrease in margins actually in the next 5 years. And what I believe is that first, wage pressure is not that high. Second, I think that inflationary pressures are much lower than what you actually see in the headlines. And third, I think that consensus is expecting already a decreasing margins, so you can see at least cementing the levels of margins that we have right now, and therefore return on invested capital. As cost of capital is coming down, the profitability of the business is improving. So it's actually the cost of capital side that interests me. I think cost of capital is coming down while return on invested capital is maintaining its pace.
How is cost of capital coming down when rates are going up?
Rates are going up, but cost of debt is not going up, because one thing is the headline rates, and another completely different thing is the cost of debt and lending, and the credit environment is extremely loose. Actually, all central banks are between 200 to 300 basic points behind the curve. So
even in the United States?
Yeah, in the United States in particular, actually. So credit conditions are extremely loose, and cost of equity, which had gone up in the last 5 years, is actually starting to come down now, because there's less perception of risk, and as such, weighted average cost of capital is improving, despite the fact that headline interest rates can be going up a little bit.
Dan, Kevin, thank you very much. We're going to squeeze in a quick break here. Coming up on the show, if you trade this asset, it won't end well. Find out what Warren Buffett is warning about right after the break.
Universally, Europe is as strong as I've seen it since I joined in 2006. So I've been through all of the cycles across the last 11 or 12 years. Look, in the UK, this is actually no different. We're actually quite happy with these results. They're 1%, but they're stable. But considering...
You said 24 countries are 10% plus. You've never seen it better in continental Europe since 2006, and the UK's turning in 1%.
Yes, because of the massive uncertainty we've got here. So this is simply, if you remember, two things drive our business. First is clients. What investments do they need? The key one is, will they replace levers in their business? The positive for the UK is they are. So, you know, we've got a very large business, very profitable in the UK. They're replacing levers. What we're not seeing is any front-end investment. We're the largest recruiter in construction and property, for example. We're seeing little or no new starts for new projects. In manufacturing, little or no new investments. So there's a lot of maintenance spend going on with our clients at the moment. And you compare and contrast that with the rest of the world, whether it's the Americas, whether it's Asia, whether it's Europe. Everybody's now focused on growth. Whereas 2 or 3 years ago, they were still focused on cost control. Now they're focused on growth.
Pushing onto some of the home builders, perhaps one of the most interesting parts of the market this week other than retail, because string of updates like Persim and Taylor Wimpey, but none of it is creating a positive reaction. Very different to the end of last year, where most of these companies could do no wrong. You've got a pullback now taking place in another name, Barratt Development. It's reported that its sales rate remains flat in the latest 6 months of 2017 compared to the same period last year. Britain's biggest house builder said home completions rose 2%, with average selling prices up 6.5%. So despite some decent numbers in there, still stock falling, down 1.2%. The UK government has revealed that it has already drawn up contingency plans to respond to the potential collapse of Carillion, according to a report in the Financial Times. The British construction company is one of the UK government's biggest contractors and employs 43,000 people. Carillion met with key stakeholders on Wednesday. The company was hit by a series of profit warnings that have damaged its share price. You can see that dramatic fall that took place late last year. We've been down 51% in the last 3 months, and now 6.5% in session today. Well, Sodexo has reported organic revenue growth of 1.9% for the first quarter of the fiscal year, less than expected, reflecting weak performances in the North American schools arm of the business. Now, despite the modest results, the French Food Services Group says it is confident of achieving its full-year financial targets. This comes alongside the announcement it has bought a majority stake in Food Sherry, a French food delivery startup. You can see it's been very weak trade this year. There's been a lot of concerns about this business, and I think there's a couple of ratings changes in the last few sessions which has pulled the stock price south. So the selling continues today. Bayer, let's get into that reaction. Germany's Bayer has cut its stake in Covestro to 14.2% following a placement late yesterday. It sold 21 million shares at a price tag of 86.25 euros a share, and you can see the retreat that's taken place in Covestro today as a result, down 1%, although Bayer has picked up on the back of the news. Jeff.
Yeah, thanks very much indeed for that. Let's get back to Kevin Boscher then, Chief Investment Officer at Brooks Macdonald. Daniel Lacalle is still with us, of course, Chief Economist and Investment Officer at Tressis Gestion. Kevin, very interesting, just looking at your notes here. You know, you've been very much engaged, I think, with the risk on trade all through 2017. And as I read for Nuance this morning, it does seem you're suggesting move to a slightly more diversified portfolio, stay away from cash still, but actually perhaps try to balance out the risks of a significant pullback at this stage. What do you see that's making you suggest that for investors?
Okay, so I mean, I think we're still bullish on the whole because we still see this environment of reasonably strong global economic growth, synchronized global economic growth, but low inflation, which will enable central banks to be very gradual with their removal of accommodative policies and very predictable at the same time. So that's a pretty good environment for risk assets. And indeed, last year's rise in equities was largely, on the back of strong corporate profits growth. There was very little multiple expansion, and we expect more of that this year and maybe even into 2019. A couple of things that make us more nervous. One, we've been pretty, pretty casual on inflation. We have not seen inflation as being a major problem anywhere for some time, despite everyone warning at the start of the year that this is the year where inflation gradually picks up. So we've got inflation broadly right, but even we acknowledge that against this strong growth background with further fiscal cuts coming through, we could see inflation tick up, particularly in the US, mainly in the second half of the year, which could put a bit more pressure on the Fed to raise rates 3 or 4 times rather than the 2 that the market currently expects. Having said that, we remain in the secular disinflationary camp. We just don't think with too much debt around at a global economy level, with excess savings over investment, we just don't see any pricing pressure across most industries. So we don't think inflation is going to pick up materially above central bank targets, and the central banks, frankly, would welcome inflation picking up to those targets. Yeah. But nonetheless, this could be a year where inflation does pick up a bit, putting a bit more pressure on the Fed, maybe other central banks. Equally, you could have, like the Chinese story, it could be that bond yields or treasury yields are put under pressure from other technical issues, whether it be Chinese, whether it be ECB and Bank of Japan, cutting back on liquidity in the second half of the year. So that's one risk. The second key risk is that China slows in the second half of the year as it just reins back in some of this strong credit growth against the background of high debt levels. And China is a key driver of global economic activity. Those are the 2 key risks. But our core view is that equities remain the best place to be. We think there's better value in areas outside the US, so we've shifted some exposure to those areas. But we have to recognise that if something material changes that is likely to negatively impact our bullish macro views, then we will have to further change strategy.
My opinion is slightly different. I agree with you on most things. I think that's still a good environment for risky assets, but I think that the difference of sentiment in 2018 relative to 2017 is that we started 2017 with everybody extremely worried about global growth, China, the US recession, Fed hikes, you name it, ECB closing, a nightmare. No? The problem that I find right now is that everybody's bullish on everything. And the thing that I'm very, very concerned about is that, and I agree with you, is that expectations of growth in emerging markets are too optimistic, in my view. Inflation expectations are too high, and that in general there is a sort of no risk, synchronized growth, everything is fine type of environment, when we've had a record increase in debt in 2017 that has not been reduced by a better growth. Therefore, I think that the biggest risk for 2018 is that emerging markets have not reduced their imbalances, they have increased them, and if the dollar weakness reverses, it's going to create a very immediate, sudden stop in emerging markets. Therefore, I'm more likely in developed markets, and I'm more likely to invest in assets that are less exposed to the cycle.
I mean, I think Kevin's your man, because from what I read here, Kevin, you're not expecting big capital gains through this year. You're in fact encouraging people to look for income producing assets, because you'll do better out of income than capital gains.
Well, certainly if you're looking beyond the next 12 months, certainly with valuations where they are, which is stretched in many markets, but that's true of bond markets as much as in equity markets. And at the end of the day, equities is a relative game relative to bond yields on the whole. But valuations are stretched, and also we are in the secular low growth, low inflation camp. So in that environment, we think returns for most asset classes are going to be lower on a 3 to 5 year view. So therefore, income's a very important part of that.
Kevin, nice to see you. Thanks so much for coming in this morning. Kevin Bosch, Chief Investment Officer at Brooks Macdonald.
UAE Oil Minister telling CNBC exclusively that OPEC measures are bearing fruit. More with Hadley from Dubai in just a few moments' time.
Karen, I have just tapped into a search engine, a well-known search engine, the word Merkel. I thought I'd just do it as an exercise, see what comes up, news stories, first thing. And the first thing that comes up is a piece by Alexander Gerlach, who is an affiliate professor at Harvard and a senior fellow at Carnegie Council for Ethics in International Affairs. An article he's written, a very good article, I think, actually, a very interesting article in the New York Times. And it talks about the very fragile position that Frau Merkel is currently in. And the headline for the New York Times piece, which is published today, is Angela Merkel done for? Very interesting piece. I mean, we've got a great piece on Cnbc.com as well, but let's be honest, there's some good pieces elsewhere as well. Now, the reason I mention this is because there are some flashes from Herr Schulz, who represents the SPD, and, of course, the Social Democrat leader in talks with the German leadership as well, of Frau Merkel and the rest of the Christian Democrats. So, what's Schulz saying? He says, on the last day of exploratory talks, we will make clear we need a start for Europe, a new start. We will make suggestions on how to renew and strengthen cohesion in Europe. If we agree to join the government, the condition will be that the government makes a strong Europe. Big hurdles still to clear in forming a government as well. Now, just very briefly, Daniel, because we've got to get to Hadley as well, but in the article from Alexander Gerlach, he mentions Jens Spahn, who may be a Kurz-type character. Kurz, of course, the new leader, chancellor over in Austria, 37-year-old Jens Spahn. Is Germany, do you think, ready for new leadership? Because that would be extraordinary if they are.
I think that there are risks, and definitely very important risks there. The Energiewende, the energy policy of the government has been a disaster for consumers. The Germans in general perceive that they have been left behind in terms of all the austerity, all the cuts that they have received while bailing out the rest of Europe. So there is a perception that the average citizen is not getting what they were promised about a stronger Europe. And the coalition is very, very fragile. So I think that all those things have to be taken into account. I agree that there is risk of that happening.
And just to add the other side of the talks, Frau Merkel is speaking and saying it's going to be a hard day, hurdles to clear as well.
That article you're mentioning, very interesting. It points out that she is better at crisis management and not a visionary. Which, I don't know whether everyone would agree with that.
Well, I mean, I agree with you. I mean, whether it's Energiewende or Willkommenskultur, I mean, she's gone her own way, and like it or not, as a German, and obviously they're very, very split at the moment, I think she's been very bold in places. I think we better move on because Hadley's waiting for us as well, but we'll come back to this one if we may.
We'll do.
The UAE's energy minister has told CNBC exclusively that OPEC is committed to seeing through its supply cuts for the rest of the year, adding that he expects a fully balanced oil market in 2018. But when, Hadley, in Abu Dhabi? When?
It's a very good question. A lot of positivity from the UAE's oil minister today. He's very excited, it seems, about what's going to happen next over the next year, essentially telling me that OPEC today is a family, that they're all working very closely together, and he isn't worried about supply shocks, shortages. Let's listen to what he had to say when I asked him, is there a price point for when we'll start to see this exit strategy take shape? Listen in.
We believe that the 5 years average is a good point for us to have as a reference. And if that is true, then we still have some room for improvement to achieve that level. Do we have enough investments coming to the market to bring the new oil that the demand or the world is needing in terms of demand growth? Everyone, if you remember last year, was expecting 1.2 demand, but we ended up with at least 1.5, and we ended the year with a demand level of almost 2. So this means that the whatever forecast you have and you put, it's not necessarily that the world is going to meet it. The expectation for next year in terms of for the world economy growth is strong, at least what we had in 2017, if not stronger. So if we have that, which means that we will have a strong demand, then the expectation is to have new investments coming to the market. But there are good news, actually. ADNOC have announced a $109 almost billion investments in the next 4 years through the value chain, throughout the value chain. And Saudi Aramco have announced, I think, similar level in the next 3 years. So NOCs and I think IOCs with time, they will come to put more investments. And that's what we targeted. The pace of that would trigger a correction of or taking care of the risk of the supply and demand imbalance. If we achieve that level, then we will not have shocks to the world economies of a very high prices and a very low prices. If you ask me about 2017, on average, it's a good year, but we have seen $40 and we have seen almost $70 within the same year. For policymakers, for people who are looking at budgeting for a country, that is not a healthy fluctuation.
So the minister there essentially telling me that this market today is less about speculation than really it is about the fundamentals, and that's how everything seems to be shifting. He was very positive for the 2018 outlook. Remember, he did say again and again to me over the course of this 25-minute interview, he talked about OPEC being a family. He seemed to think that everything's going to remain in line with the agreement in terms of OPEC and non-OPEC members. But as you mentioned, Steve, the big questions surrounding what's going to happen with Russia and whether they're going to be able to hang on through the rest of the year. Guys?
Excellent, Hadley. Thank you very much indeed. Yeah, you're sticking to that line about them being a family, aren't you? It's just what kind of family. Right, moving on.
Liquidity. Let's talk about one of the fears in markets around what the Bank of Japan has been doing and how much liquidity still remains in the market. Now, expect global financing conditions to stay easy this year, even as central banks normalise policy. That is the latest message from T.S. Lombard on global liquidity. The firm says it's not time to worry because liquidity is even more abundant than it may seem, and it's influenced by more than just monetary policy. Shweta Singh joins us, the Director Global Macro, T.S. Lombard. Shweta, the market reaction has been quite interesting this week. You've seen US Treasury yields move higher because of concerns about this almost technical intervention by the Bank of Japan on how many government bonds they were willing to buy. The investor psychology went somewhere like, well, the Fed's exiting, the ECB is starting to lean in that direction too, but at least we can still count on the Japanese. That notion was sort of somewhat shot to pieces this week. But you're saying, don't fear, liquidity is huge still.
Absolutely. So you rightly pointed out the context as in where these concerns are coming from, because central banks have been pumping money. And on our estimates, net asset purchases by the four key developed central banks sort of peaked in 2016, towards the end of 2016. And again, on our estimates, it seems that they will actually start to cease by the start of next year. So, and that's where investors' concerns arise, because the worry is that these central bank policies have suppressed volatility, asset prices have surged, and as they withdraw these policies, the fact that economic and financial cycles have digressed so much, there will be a sudden tightening in global liquidity. The point we're trying to say is, in spite of central banks moving towards a less easy monetary policy stance, global liquidity conditions will still be substantially abundant. It will still remain accommodative. Just to caveat there, what is global liquidity? We use it to sort of talk about the ease of financing conditions in global markets. And why do we think there is no risk? Well, there is risk, but that's not our base case. Why is it that we think so? Because it's not just about central bank balance sheets. It's not just about what the market is pricing in terms of where policy direction will be. It's a much more nuanced view. And we think that the fact that the banking sector is in a much better position than it was previously, the fact that
Right, so particularly when you talk about the banking sector and financing conditions remaining supportive, what do you look at particularly? Is there an index? Is it the basis points over the cash rate that's been achieved for certain deals?
Just broad indicators such as the credit demand credit supply. We see credit demand and supply easing across, in particular in Eurozone, which has been, at the key in terms of deleveraging by European banks, was a key drag on global supply of credit. But even in Europe, we see credit demand and credit supply pick up. The capital levels at most of in the banking sector is substantially higher than it was before the crisis, and also we see improved balance sheets, not just at the banks but also in non-financial corporates and households. So there is more capacity to absorb credit, to demand credit. And then we move to the capital market side.
Can I just put you back on the households, because I think a lot of fears exist out there that households are basically up to here with debt, and you see it particularly in the States, that there's not much left for the household to simply add to the debt side of the ledger.
In the US, the story is that the households are still saving more than what you would expect them to save at this point in the cycle. So there's still capacity for households to reduce their savings level. In going back to Europe, and even in US in general, the fact that we expect real wages to finally start to pick up gives them more sort of boost on the real income side.
Right, Dan, jump in.
Massive liquidity injection. Completely agree with you. Credit conditions extremely loose. However, credit demand is actually not growing as central banks need it to grow to generate the inflation that they need in order to pay for the massive increase in debt that we saw in 2017, which was the highest debt binge in the last 15 years. So the problem is that they're trying to push people to drink from the well that they don't want to drink, precisely because inflation and wages are not following inflation. And I think that the risk that we find for that matter is that liquidity will continue to be significantly higher than credit growth, because that is the big problem, is that central banks are looking at a normalized level of investment and a normalized level of credit growth that is based on 2007 levels, which was a bubble. So what is the risk of becoming a new bubble?
That's exactly what we're trying to say, that the fear is not that central banks will tighten policy.
No, they will not.
Yeah,
Can't.
The risk is that central banks will remain behind the curve.
Way behind.
And that means you are inflating this bubble, which will burst, but it's not this year. And one reason why we're not that worried at this point in time is the dollar. The dollar is crucial for global funding conditions, and we think that the dollar will not really appreciate from these levels, especially against the euro. And that might seem controversial because the divergent policy stance by the Fed and the ECB. But fundamentals are again coming back to the fore, and they will reassert in a much stronger euro.
So a much stronger euro, much lower inflation in the European Union because of a stronger euro means risk of growth, risk of earnings, and risk of a credit environment, because the debt to EBITDA in the European Union has actually not gone down, it's gone up.
Yeah.
So if you have a much stronger euro, the earnings growth that is expected for the Euro Stoxx 100 wipes out.
Sure. When I say much stronger, I need to qualify it. It's around 1.19. We expect it to go to 1.25.
Okay.
To 1.25. So that might seem a punitive level for some economies in the Eurozone, like for Italy in particular. But for Germany, that is roaring ahead. For Spanish economy, that's roaring ahead. It's not really that much of a constraint. And besides, the wage setting process that will come, that will start to that begins this year, for example, will take into account. It's very backward looking. So when wages were set last year, they were looking at inflation that was hardly 0%, but this time around, when wages are set, they will be at a relatively higher level. So I take your point that these risks are very much there, but we don't see them unravel, not this year at least.
Shweta, there's a big expectation built into that, though, about the direction for the dollar here. And are we not just building up structural problems and vulnerabilities because so much of this lending in EM and DM has taken place in dollars, not in euros. And the only central bank that I'm hearing saying that they are definitely raising rates this year is the Fed, 3 times.
Yes.
Why is the market not going to push the dollar higher on that expectation? We've also got the repatriation flow, which is set to take place yet, which again will see money coming out of other currencies into dollars.
Right. So yes, the direction, the level of the dollar is crucial in relatively sanguine in our relatively sanguine view on global liquidity. And I cannot overemphasize to what extent the vulnerabilities have built up, especially in emerging market non-financial corporates. There is rampant evidence of carry trade, for example. So why do we think the dollar will not appreciate? Because because the dollar, for starters, is not really undervalued. The dollar, for starters, is at a fairly it's at a level that does not really justify further appreciation compared to its, say, fundamentals, as compared to the euro, for example, because the euro is substantially undervalued. There are more upside surprises to come in the eurozone. That means a bit more equity-related flows. But what's more important is that we know a central bank QE has created distortions across the world, but the extent of distortions created by the ECB is substantially large, and that has sort of pushed portfolio outflows from the eurozone, and they are unhedged. A lot of these portfolio outflows are unhedged. So once they come back, they will come back because of these huge distortions, and that will push the euro higher.
We better wrap it up, I'm afraid. But thanks so much. I think we got the gist of that. Shweta, nice to see you. Thanks so much for joining us. Shweta Singh, Director for Global Macro at TS Lombard. Let's take the break here. When we come back, which asset class does Warren Buffett say will come to a sticky end? We'll be back with that right after this. Speaking to CNBC, Warren Buffett said Bitcoin investors are in for an ugly surprise.
I get into enough trouble with things I think I know something about. Why in the world should I take a long or short position in something I don't know anything about? So, we don't have to know what cocoa beans are going to do or cryptocurrencies. We just have to focus on 8 or 10 stocks, businesses basically, that we think are decent businesses. But I do think that I think what's going on definitely will come to a bad ending.
Warren Buffett on Bitcoin. It'll come to a sad end, says Warren Buffett. Arjun, a tech reporter, has joined us around the desk. What is this story doing to the value of cryptocurrencies?
Well, we saw earlier about $100 billion worth of value was wiped off the entire market. Earlier, a lot of those losses have been paired now. Ripple is slightly back up, and a few of the other cryptocurrencies have also paired some of those losses. So it seemed to be a quick flash on the news. Because South Korea is a very important market to the cryptocurrency market. They account for somewhere in the region of 15 to 30% of Ethereum trade and Ripple trade, a bit smaller on Bitcoin, but they are a key participant.
When my son was at school, he was at school with a couple of South Koreans, and they played a lot of League of Legends. And I said, well, you play like this, you're almost professional. He goes, no, you've got to be South Korean to be professional, because the gamers all come from South Korea. Is that the truth of this? They're all just gaming it rather than actually investing in it?
Well, the government's actually called it pretty much similar to that, a gambling and speculation, and the premiums on the Bitcoin exchanges over in South Korea are much, much higher than in the US or any other country as well. So there is a sense that there is a lot of gaming here going on, and that's what's happening in South Korea.
Now, what I find fascinating is that everybody is calling Bitcoin and cryptocurrencies a bubble, exactly the same people that never predicted a bubble in the first place years ago. So what I find fascinating here is that everybody is calling the collapse of cryptocurrencies based on repression, based on governments banning it, not because of the demand or supply of those currencies. So I'm intrigued about the fact of whether you believe that government repression is actually something that can stop the cryptocurrency bubble.
Yeah, it's a bit difficult to see, because at the moment we heard China saying they're going to ban it, and then they very quickly did a U-turn on that. Now South Korea is saying, well, actually, this is not finalized, guys. They did pour a bit of cold water just not long ago. So this ban on it doesn't seem to be stopping it too much, and it seems like there's going to be new cryptocurrencies popping up all around the world, and people are going to continue to trade them.
Well, we've got to engage the blockchain and say goodbye. Arjun, thank you so much for coming and helping us out. Daniel, thanks for being our guest host this morning. That was Squawk Box, everybody. Stay with the channel.